All right, let's jump right in. If you're prepping for any banking or finance exam in India, you already know that RBI circulars are an absolute goldmine for questions. And today, we are tackling a really big one, a recent change in how banks can raise a special type of capital from overseas. Now, this isn't just some minor update, it's a complete overhaul, a simplification of a rule that used to be pretty complex. So stick with me, because really getting a grip on this topic could give you a serious edge.
So here's our game plan. First, we're going to decode the essential jargon. Gotta speak the language, right? Then we'll look at the old 2021 rule, see it in action, and then dive into the new 2025 directive. After that, we'll put them side by side to really see the difference. And we'll wrap it all up with the key exam takeaways you'll definitely want to screenshot. Okay, first things first. Before we can even begin to tackle the rules, we need to get the lingo down. These next few concepts are the absolute foundation for everything that follows, so let's get these locked in tight. First up, you'll always hear about Basel III. What is it? Well, think of it as the global safety manual for banks. After the huge financial crisis in 2008, regulators all over the world basically said, okay, banks need to be way stronger. Basel III sets those international standards, and pretty much everything the RBI does in this area is about putting those global rules into action right here in India. Next, this term, AT1 Capital. So what is this stuff we keep talking about? It's a really special kind of funding that banks use to build up their strength. A huge piece of this puzzle are things called Perpetual Debt Instruments, or PDIs. You can just think of them as bonds that never expire. And here's their superpower. If a bank gets into trouble, these bonds can actually absorb losses, which acts as a vital safety cushion. Pretty neat, huh? And finally, risk-weighted assets, or RWA. Honestly, this is a brilliant concept. Instead of just adding up all of a bank's assets, regulators give each one a risk weight. So a super safe government bond might get a really low weight, but an unsecured personal loan, that gets a much higher one. RWA boils all that down into a single number that shows a bank's total risk. You have to remember this term. It shows up everywhere. All right, now that we're all on the same page with the jargon, let's hop in our time machine and go back to October 2021. The RBI put out a circular that laid down the law for how much AT1 capital our banks could raise from other countries. And as you're about to see, it was, well, let's just say it was a bit complicated. So here it is, the key sentence from that 2021 circular. It set a cap of 49%. Okay, simple enough. But 49% of what? Not of their total capital, but of this fuzzy thing called the eligible amount. And figuring that out, well, that was the tricky part. And here's where things got messy. It was this whole two-step dance. First, a bank had to calculate two completely different numbers. One was 1.5% of its risk-weighted assets, and the other was its total existing AT1 capital. Then, it had to pick whichever of those two numbers was bigger. Only after all that could it finally calculate its 49% limit. It was a bit of a maze, wasn't it? You know, to really get this, let's just walk through the exact example the RBI itself used in that 2021 circular. This is pure gold for your exam prep. We'll imagine a bank with risk-weighted assets of 1,000 crore rupees. Just look at the difference this created. In case I, our bank has no existing AT1 capital, so its limit is a pretty small 7.35 crores. But in case 2, just because it already has 50 crores of AT1, its eligible amount shoots up, and its overseas limit more than triples to 24.5 crores. Think about that. It's the same bank with the same risk profile, but it has a wildly different limit. This is exactly the kind of complexity the RBI wanted to fix.
So that was the old way of doing things. Now, let's fast forward to the big change. The RBI has put out a new directive that's going to take effect from October 2025, and its main goal is just one thing: simplification. It's like a breath of fresh air. And here it is, the heart of the new rule, straight from the horse's mouth. Notice what's missing? Yeah, there's no mention of 49%. There's no confusing eligible amount. It's just a clean, direct cap, a maximum of 1.5% of risk-weighted assets. Boom, that's it. And the RBI made this crystal clear. As of October 1st, 2025, that old 2021 circular, it's gone, repealed, wiped from the books. This new single direct limit is the only rule that's going to matter from then on. Okay, this is the part I love. This is where it all just clicks into place. Let's put the old and new rules right next to each other to see just how dramatic this change really is. Just look at this. This one slide shows the whole journey from complexity to simplicity. On the left, you've got that tangled mess of a formula with its higher of clause and the extra 49% calculation. But on the right, look how clean that is. A single, elegant calculation tied directly to risk-weighted assets. No more confusion. Now let's go back to our bank with 1,000 crores in RWA and see the magic happen. Remember how the old limit was all over the place depending on its existing capital? Well, look at the new rule in action. In both Case I and Case II, the limit is now exactly the same, a flat 1.5% of RWA, which is 15 crores. It no longer matters how much AT1 capital the bank already has. This creates a level playing field, a standardized, predictable limit for everyone. All right, deep breath. We have covered a lot of ground. But if you're crunched for time or you just want the ultimate revision cheat sheet, this next slide is for you. If you remember nothing else, remember this. Okay, let's nail this down. The circular that's been repealed is the one from October 4th, 2021. The new directive kicks in on October 1st, 2025. You've got to know that date. The old rule, that was the complex two-step calculation. The new rule, a simple direct limit. And what's the new formula? A maximum of 1.5% of RWAs. And the biggest change of all, the limit is now totally delinked from a bank's existing AT1 capital. These are your potential exam questions right here. So we'll leave you with a question to chew on. We know the rule is simpler, but why? What does this actually mean for the banks? How do you think a clearer, more predictable, and standardized limit might change their game plan for raising money from global markets? Thinking about that real-world impact, that's what separates a good answer from a great one. That's all for now. Good luck with your preparation.